This is an instructor video on economics, in particular monetary and fiscal policy. This video contains some of the areas that may be covered on the BEC portion of the CPA exam. It also contains several practice questions that could be similar to what the questions that you'd find on the CPA exam. As in all the other videos, the best way to use this presentation is to review the summary information in the video. As you arrive at a practice question, read the questions and stop the video, perform an analysis, and arrive at an answer. When you've done that, restart the video and then review my answer as part of the video presentation. Now, before we move on to the summary presentation for monetary and fiscal policy, again, I want to call your attention again to the Khan Academy videos. And these two videos are on monetary and fiscal policy and the tax lever of fiscal policy. And I provided you the URL to those videos that go back to those YouTube videos that are produced by Saul Khan from Khan Academy. Again, I'll remind you that these are excellent videos. They're very basic, they're not lengthy, and they'll give you a lot of insight in addition to the summary information that I give you in this video. So with that, let's talk about monetary policy. And monetary policy is basically, when we say monetary, we're talking about the supply of money. So monetary policy consists of the control over the supply of money. And when you think about it, it's pretty logical. Money being added to the economy will increase GDP. Since people will have more money, basically, or have more money available to spend, consume, producers can consume, and so forth. Money being removed from the economy will result in a decrease in GDP. The other thing is that we have to understand is that money does have a multiplier effect. So when we add a dollar back to the economy, that dollar is going to be respent a number of times. So if we had a money multiplier of 10, if we added $10 million to the economy, if we had a money multiplier of 10, that would be the effect of adding $100 million to the economy in terms of dollars. And what we would understand also is that interest rates are partially determined. By the way, interest is the cost of money. Money can either be inexpensive with low interest rates, or it can be very expensive with high interest rates. Interest rates are partially determined by the supply of money. Obviously, if we have a certain demand for money, again, loans, people trying to get loans and things like that, what will happen is the interest rates will go up because there will be a limited supply of money. If there's a large supply of money, interest rates can go down. Higher interest rates will discourage GDP growth, as consumers will be less likely to borrow, and business will be less likely to invest because the investments become more expensive. Now, the Federal Reserve Bank controls monetary policy through several, basically 4 key items. The first thing is what we call a reserve requirement, and that is the amount of funds a bank has to keep on hand, and it has to keep those funds on hand with the Federal Reserve Bank, that reserve amount. And the amount of the reserve is controlled by the Federal Reserve. If the Federal Reserve says that they have a 10% reserve requirement, that means that a bank must keep 10% of its funds on hand, or basically must deposit 10% of its funds with the Federal Reserve Bank, which means the amount of funds it can actually lend out in the economy, it's only 90% of the total reserves, not 100%. Now, The federal funds rate basically is the rate on which banks can loan their excess reserves to each other. That rate is negotiated between the loaning and borrowing institution, although it's highly influenced by the Federal Reserve, which means if a bank has certain funds available over and above their reserve requirements of the Federal Reserve, and they're not utilizing those funds, they can loan those funds to other banks who basically are just at meeting their Federal Reserve requirements, but have the capability to that they can make additional loans into the economy. The discount rate is the interest rate at which banks can borrow from the Federal Reserve, and that's set by the Federal Reserve. The discount rate is typically a higher rate than the federal funds rate. Now, the fourth area that the Federal Reserve controls monetary policy is what we call open market operations. And open market operations is directed by the Federal Reserve through what they call the Open Market Committee, and that controls the money supply on a daily basis. And by the way, of all these particular items here, the open market operation is the most significant in terms of controlling the money supply. Basically, without getting into too much detail here, and I think you can also, if you listen to the Sol Khan video, it could be a little bit clearer, but you'll need to take a little of this on faith. Basically, in the open market operations, money supply is increased by the Federal Reserve purchasing U.S. government securities. That's called an expansionary market operations. And it's purchasing those securities from the banks. In effect, this supplies the banks who sell those bonds with cash, which increases the bank's reserves and therefore the amount of money that the bank can loan out, therefore money supply. The opposite is the Federal Reserve can decrease the money supply by selling government securities, and they call it contractionary open market operations. And what happens is the banks who buy the bonds from the Fed with cash, in effect, decrease their reserves and therefore money supply. Another area that the Federal Reserve uses to help provide control and guidance to the economy is through their economic reports. And these are various economic reports, economic analysis of the economy provided through a number of various publications issued by the Federal Reserve and also by speeches by Federal Reserve members. Let's take a look at number one. If the Federal Reserve Board wanted to implement an expansionary monetary policy, which of the following would be the most likely action? Again, go ahead and stop the video, perform your analysis, arrive at your conclusion. When you have your conclusion, restart the video. Number one, C, would be purchase additional government securities through their open market operations. Again, increasing the money supply has an expansionary impact on the economy, and purchasing government securities would increase the money supply. If we take a look at A and D, those would be actions basically that would cause a contraction in the money supply. And an economic learning curve, B, has nothing to do with monetary policy. And as you remember, what we said is the major way the Federal Reserve increases money supplies through open market operations. And again, increasing the money supply is an expansionary monetary type of action. Number two, the Federal Reserve Bank ratio. It's asking pretty much what is the Federal Reserve Bank ratio. Again, stop the video, arrive at your answer, then restart the video. The answer in this case is D, the percentage of each bank demand deposits that cannot be loaned out. And in the explanation box is a reserve ratio as a percentage of demand deposits the bank must keep within the banking system, and that's kept with the Federal Reserve Bank. The remainder may be loaned out, which can increase aggregate economic activity. On the other, if the reserve ratio is decreased, the bank can loan out more money. If the ratio is increased, the bank can loan out less money. Number 3, which of the following Federal Reserve tools is the most important means by which the money supply is controlled? Again, stop the video, perform your analysis, arrive at your answer, and when you're ready with your answer, restart the video. And the answer in this case is B, buying or selling U.S. government securities. And again, that's through the Federal Reserve open market operations. And if we take a look at B, the control of the money supply is primarily through the buying, expanding supply, and selling, contracting supply of U.S. government securities. If we take a look at A, the reserve ratio increases or decreases the amount of cash available for the banks to make loans. But while this does have an impact on the money supply, it doesn't have the impact that the open market operations does. C, Federal Reserve economic reports. That really has nothing to do with the money supply. It's basically the Fed's outlook on different aspects of the economy, although it can have an effect on especially consumer business outlook or actions on the economy. And then D, increase or decrease in governmental spending. Governmental spending is fiscal policy. It's not monetary policy. Therefore, it's not controlled by the Federal Reserve Bank. Okay, now we're going to talk very, very briefly about fiscal policy. And again, in taking your basic macroeconomics course, we talk about what government spending does and net government spending does in terms of the total GDP of the economy. But fiscal policy is the use of government revenue collection and expenditures. When I say revenue collection, that's mainly taxes and expenditures to influence the economy. So just besides running a government, you can use the activities of revenue collection and spending to actually influence the GDP. The levels of taxations and government spending influence aggregate demand and the level of economic activity. Taxes, which include things like income taxes, Social Security, unemployment, value-added taxes, etc., generally impact disposable income, thereby increasing or decreasing GDP. Lower taxes equal higher GDP. In other words, you'll have a higher disposable income. Higher taxes equal lower GDP, which means you'll have a lower disposable income. Tax revenues minus government expenditures is going to result in a surplus or a deficit. If revenue exceeds expenditures, that results in a surplus. If expenditures exceed revenues, that results in a deficit. Government surpluses are called contractionary. Tends to have a negative impact on gross domestic product. Government deficits are called expansionary, then they tend to have a positive impact on GDP. Now let's take a look at number 4. A U.S. government tax U.S. government tax increase will, and you're given 4 choices. So again, stop the video, perform your analysis, arrive at your answer, and then let's go over the answer for number 4. Let's take a look at the answer to number 4. In this case, the answer is D. A U.S. government tax increase will, D, decrease GDP and decrease aggregate demand. So if we look at this, A tax increase will result in lower disposable income. Lower disposable income will result in lower aggregate spending and therefore demand. And also remember that the impact on aggregate spending will be subject to the marginal propensity to consume, the multiplier effect. If we take a look at the economic supply and demand curve in this particular case, what we do is we start out with demand rather. And in this case, since we have a decrease in disposable income, what will happen is the demand curve will shift to the left. So if we see our equilibrium point originally, we see the certain price and we see the certain quantity, but then when we show our demand curve shift to the left, D1, we end up with a market equilibrium that shows that we have a lower quantity going to be supplied at a lower price, therefore reducing GDP. Okay, let's take a look at number 5. If the government were only to use fiscal policy to stimulate the economy, it would. Again, stop your video, perform your analysis, and when you're done, go ahead and restart the video and listen to my answer. Okay, number 5, if the government were only to use fiscal policy to stimulate the economy, it would, in this case, D, lower taxes and increase government spending. Lowering government taxes, which will increase disposable income, and increasing government spending, which would cause a positive demand curve shift, resulting in a higher GDP. And you can see the illustration here is when we start out with the original demand of D, it shifts to the right to D1. Okay, if we take a look at choice A and B, the actions for A would counteract each other. Increase taxes and increase government spending. Increasing taxes will lower disposable income, which will have the effect of decreasing GDP, where increasing government spending will have an effect of increasing GDP. So they kind of counteract each other. If we look at B, lower taxes and lower government spending, we're going to have a higher disposable income, yet we're going to have higher disposable income, which means we will have a higher GDP. But in the case of lower government spending, the lower government spending is going to result in a lower GDP. So you have these two elements counteracting each other. And again, remember, what we're saying is the government were to only use fiscal policies to stimulate the economy. Okay, and then choice C is basically that talks about increasing the money supply, and that is monetary policy, not fiscal policy. And with that, that's the end of this instructor video on monetary and fiscal policy.